Monday morning, folks. Welcome to a brand new episode of the Finmet Mondays podcast. Sunil, both gold and silver surprisingly came up short with respect to US dollar last week. As the war escalated and we progressed through the week, we saw that the US dollar was benefiting a lot more, uh, just purely in terms of price as compared to gold and silver. They both saw corrections, and by Thursday, Friday, there was a little bit of a improvement in the prices. What did you make of um, this trend where we were completely expecting the opposite? Actually, we were expecting gold to run through 5,500 levels or 5,400 levels. But what did you make of this?
I mean, what happened on gold is we touched 54.50, I think,
Yeah.
54.30, and then now we're trading at 5,100, 51.20. Silver touched, I think, 95 and came. Now we're trading at 86. So clearly, there's been a pullback of around 5 to 10%, 5% in gold and 10% on silver. I think my reading is the fact that gold and silver, the margins on CME futures for silver especially are very high. Gold also are historically high, 9%, 10%. So what I think has happened is that people had profits, plus people had um, margins in gold and silver, and they were seeing a lot of volatility in some of the other asset groups, and some of the leverage positions there were probably requiring, especially oil, were requiring additional margins. So people moved their positions, they closed their positions on gold and silver, and moved it into the other asset groups because the other asset groups were seeing far more volatility. And so, in that sense, I think people are sort of rushing away from gold and silver right now because they need liquidity to fund other positions. So that's what my take would be. I think the good thing is that we did pick up again from the lows that we saw earlier in the week, and right now we're on the sort of upward trajectory as far as gold and silver is concerned. So probably if you could have a look at the technicals and let us know what to expect in the coming days.
Let's quickly look into the technicals, Sunil. What I have here is just across the entirety of last week, which specific asset groups did actually see a benefit price wise as compared to which ones see a decline. And you'll see right at the end, the three that we've seen as the beneficiaries are Bitcoin, the US dollar index, and the US on NASDAQ 100. Right? So it clearly shows you that um, there definitely was a higher demand for the US dollar as a result of the war situation. We can see that in the WTI crude oil price chart as well. Around the 2nd to 3rd of March, you see the price has increased from $72 all the way to $92. There's a sharp spike in the WTI crude oil prices. And obviously, this is because of the supply disruptions that we're seeing in the Middle East. What this has led to, as a result of the increasing oil price, is a repricing of inflationary expectations and interest rate expectations. The markets are repricing the timing of these rate cuts specifically. From this chart, which shows us the probability of rate cuts across different meeting dates of the Fed this year, we see that there's an expectation largely that up till June, interest rates are going to be steady. They're not going to see a rate cut up until June. Up from July onwards, we start seeing that there might be a 25 basis point rate cut. But again, these are still 4 months down the line. So these have to be taken with a pinch of salt. And where we see the first another 25 basis point rate cut is directly in December of 2026, 9th of December 2026. What this effectively means is that one rate cut this year, which is 25 basis points, and nothing more. But when we started this year, we were probably thinking 2 or 3 rate cuts this year. So you're seeing how the markets in lifetime are thinking of inflation, then thinking of rate cuts being steady and not coming down. And as a result of that, you're seeing US treasuries being the beneficiary across this. People are wanting to rotate out of gold and invest in US treasuries, US bonds. And as a result, you see a simultaneous increase last week in US treasuries and a simultaneous drop and a pullback in gold. Now, looking forward, we have 3 to 4 resistance levels that I'll just quickly read out. We have this intermediate level at 5,200, which is where gold paused on Friday. We then have this another level, which is 5,280, which is the next level that we have to watch out for. And on the far side, we have these highs here, which is at 5,450 and 5,600. Main level to watch out for this week is this yellow trend line that you see here, which is a 20-day moving average. It looks like, at least of last week, gold found support along this 20-day moving average trend line. Interestingly, this is also where you see support from this structural trend line right here. And you also see that when you draw this Fibonacci retracement, the 61.8% line also converges around this line. So you have three technical indicators and structural indicators converging around this line. So we need to wait and watch whether gold is going to break this 50-50, 50-40 area. Because if it does, you might see a major reversal after that, and it might catch a lot of bulls out of place. Let's see how the markets play out this week. But till then, thank you so much and goodbye.